Hey, good morning, everyone. Marty Missouri here. It is the 29th of April, 2026, a while before the cash open in the U.S. It's been a while since I've done a video, but I thought this morning would be a good time for me just to pop in briefly. Plus, it's pretty much what my schedule allows this morning. Tomorrow or Friday or both, I'll follow back up with a written note like I have been most mornings of late. So first, kind of want to talk about what we're seeing, what we're thinking. Of course, the news is, at least the market moving news, probably more so even than earnings right now. Normally this would be all eyes on earnings. Today there is a Fed meeting that will be important and could be market moving as well. We have a new Fed chair coming, pending final approval in Washington, which we see as forthcoming. And no doubt we will talk a lot about that and the dynamics and the prospects and so forth, and what it all means for markets for the rest of the year. The situation around Iran and primarily the Strait of Hormuz is definitely impacting our portfolio, our overall allocation, how we think about things. We've made a number of adjustments this year, several in response to what's going on in the Middle East and what we expect outcomes to be. We're running 3 different scenarios and applying probabilities to those and testing them against our portfolio. I started yesterday, again, as I do frequently, going through our bull and bear narratives, meaning challenging our own theses on every single position we have in our core portfolio. How it stands by itself, how it looks to us long term, how it looks against our different Middle East scenarios in the near term, and how it's sized in our portfolio. Giving you a lot of that on the written blog here of late, at least in synopsis form. Still pretty heavy in cash, still hedging equities and our gold position with options, taking the current situation very seriously, but not reacting to any of it emotionally or with panic or anything like that. Consequently, year to date, if you get the full complement of our core allocation, which means you have to have a portfolio worth more than $100,000, you're doing still notably better than the U.S. equity market. Again, that's not our benchmark, but it is what people think about a lot and compare most firms to, although we are a global macro shop, so stocks are just one component of what we utilize in our portfolio. Smaller portfolios, we apply our long-term thesis, but with a much more concentrated portfolio. A handful of positions as opposed to several dozen. Those portfolios are holding up just fine as well. At times, because of the concentration, they will outperform our larger core allocation. At times, they will underperform them. But again, all of it gets lots of attention and adjustments as we deem necessary. So I'm going to leverage the charts a little bit. I want to talk about some relative performances across the globe and across asset classes, but I am going to keep it relatively short. So again, it's been a while since we looked at the technicals. This is the S&P 500, and you can see we're right there again at all-time highs. The momentum has been pretty good as the market has come barreling back and recaptured we'll call it the Middle Eastern correction here of roughly 10%. Again, this is the S&P 500. These upswings and this gap is all on news or commentary that we're getting real close to a deal. If that were to fall apart, or if general conditions were to really roll over, and I've been showing you each weekend that conditions in the U.S. are holding up actually pretty well so far. I think we need to be concerned the longer this goes. Right now, oil and gas inventories are being depleted quite rapidly. That's going to show up in higher gas prices, make no mistake, over the coming weeks. That's, of course, political risk, given midterm elections that are coming up. Consumer sentiment, if you look at the Michigan survey, is literally never been this poor, despite the fact that the market is holding up okay. And the Conference Board's consumer confidence did tick up a little bit better than expectations yesterday, but still really low relative to what you might expect, again, with stocks at all-time highs. That kind of standard correlation between those sentiment indices and the stock market has really broken down. So that speaks to, maybe the actors in the market right now and what's keeping it afloat. So again, just looking at the daily chart, market looks like it's beginning to stall right here, maybe consolidate. You can see momentum rolling over a bit, got overbought coming off of those levels. Big earnings week this week. Again, I mentioned the Fed meeting today. Could be some fireworks actually in either direction. What I think will lead to something significant to the upside has to be, at least for now, a reopening of the Strait of Hormuz. As for the NASDAQ index, you can see very similar look. Slightly overbought coming off of those levels, slowing down in terms of the ascent right here, but it also in all-time high territory. I'm going to talk to you about the sectors here in a second. Gold, on the other hand, has been a drag for us of late. You can see it definitely has broken down. It's getting close to testing the low of the year, which was a 22% decline from the peak. And this was very much to be expected. Remember back in here when we were starting to hedge, I talked a lot about the monthly chart, that we'd never seen it at those overbought levels without a double-digit correction. So we saw a 22% correction. This is that last consolidation box at the end of last year, second half of last year. And you can see we tested that. We tested the high end of that, bounced right off of it, but then lost it right at the 50-day moving average, and then coming down here again. The way gold is correlating of late simply to the prospects for interest rates says that a reopening of the Strait of Hormuz and a potential alleviation of that inflation pressure, or that inflation perception that it would be durable, would probably be very, very bullish for gold in a not small way. Our long-term structural thesis for gold says to hang on to it and be patient with it, despite the fact that it is, given up a lot of the gains that we've seen here of late. 10-year yields has been problematic for gold in particular, as I just said, and so has the dollar. Responding to higher yields more than anything else, I think, as I just illustrated for you. And again, that becomes, a headwind for commodities in general, gold in particular here of late, but it's really this one right here that's bothering gold the most. Let's look at some ratios. So our notable outperformance last year, and even still year to date, has been largely due to not just our commodities exposure, but also our non-U.S. exposure. And again, a rising dollar is going to be a headwind for that. We've seen it here mostly in the ratio between developed markets, Europe, Western Europe, Japan, etc., and the U.S. So you can see that we were significantly up right before the Iran conflict. Our developed non-U.S. markets were outperforming the U.S. by a full 10% 2 months into the year, and it's pretty much given that back. Right now, it's pretty much a dead heat between the U.S. and developed foreign markets. Emerging markets, on the other hand, are still outperforming developed markets by a full 10%, and we have a meaningful allocation to emerging markets. The Bloomberg Commodity Index is still 22% outperforming the U.S., and gold is still outperforming U.S. equities by about 2%, which explains, again, why in our core allocation, which captures things like gold and more commodities, is holding up very well relative to stocks so far this year. And by the way, with significantly less underlying risk as we score it. Okay, but looking sector by sector to give you a feel for what is moving the U.S. market, tech has caught a nice bid. You can see it was down 5% below the S&P 500 as of the end of March, and right now it's 5% above. We actually did rotate a bit here recently out of our yen position into technology stocks. Financials, they're underperforming the S&P by 9%. That has been a drag for sure. We added to financials at the beginning of the year. We are anticipating more very bullish deregulation for the sector. Right now it's struggling with perception of credit risks in the private credit market, how that might impact banks. Rising interest rates in a good economy ultimately is a net benefit for banks typically. Right now they're struggling. We're still bullish on banks though for the rest of the year. Consumer discretionary, we came into the year adding it back to our allocation, hadn't owned it in a while, anticipating record tax refunds, the One Big Beautiful Bill Act, and the fiscal juice that would throw into the economy, reigniting animal spirits. However, while we were just getting nicely into the green, of late, with consumer sentiment and so forth, you can see that consumer discretionary has rolled over and it's underperforming the S&P 500 by 6%. You get a resolution to the Strait of Hormuz, you get gas prices coming down some perhaps, but just overall sentiment improving. If that were to happen, we think this could be a very important place to be. Materials are outperforming the S&P by 9%. That's in our favor. Energy has been ridiculous, of course, and it makes nothing but sense, outperforming the S&P 500 by 24%. Opening the Strait will, of course, see these stocks take a hit, although we are sufficiently allocated to what will do well that we don't need to react to that. Industrial stocks are outperforming the S&P by 5.7%. When we get to the economically defensive sectors like staples, outperforming the S&P by 2.5%, utilities by 4%, but healthcare taking a pretty good hit, 11%, underperforming the S&P 500. So healthcare, financials, discretionary stocks, all down on the year. Not a great sign, of course, about the prospects for the overall economy. However, tech coming back. And then the materials hanging in there. Of course, that's going to be impacted by the inflationary aspect of the geopolitics and so forth that we're dealing with. Remember, folks, structurally, we are in the camp that says inflation is going to be higher for longer, and we are allocated to take advantage of that. The whole Iran situation has definitely thrown a wrench into lots of strategies. Again, ours is holding up very well so far, but we're not taking anything for granted. And then lastly, the consumer staples to consumer discretionary ratio. Again, I showed you that consumer discretionary stocks are down on the year. Staples are up, so there's a 9% differential in favor of staples, which we own. We own both of these, XLP and XLY is something that we just reintroduced this year and have been added to here of late. XLY will outperform markedly, I think, if we can get some of these geopolitical risks lessened, or if they will abate in the near term. And the pressures on the powers that be on both sides of the conflict almost demand it. But again, there's lots of incentives, constraints, risks to consider along the way. It's a very fluid situation, as you might imagine. So, folks, I ripped through that fairly quickly. Just wanted to make a few points. Watch for the written blogs, clients. I want you taking those in. Hope you have a great rest of the week. I'll talk to you again soon. Bye-bye.